We're now looking at the fringe benefit, which is assets acquired at less than the actual value. Referenced in paragraph 2a, that's where it tells you it's a fringe benefit. In paragraph 5 contains the details. One thing that is important to note about this section is that ownership is transferred to employee. So you get the asset when the employer gives the asset to the employee is now the new owner. Ownership is transferred. This section is basically a situation where you receive an asset from your employer. So you're the employee, you receive an asset from your employer, and you either don't pay anything for it or you pay less than what it's worth for it. This section does not apply to money, meals and refreshments, shares under section 8b, which you don't have to worry about in any case, it's out of your syllabus, and shares under section 8c. Right, if the employer gives the following assets, there's no value attached to it. Okay, so let's just stop up to there. So up to this point, these assets, there will be values and everything, but we just don't apply it, so they're exempt from this section. For the following assets, there will be no value, so it's null. If they give you fuels and lubricant for a company car, and that's because you're going to be taxed on the company car, or if they give you immovable property given by the employer to the employee. Right. So immovable property, so see just up to here, hold on. Up to here it says, if the employer gives immovable property like a house to the employee, there's no fringe benefit. However, there will be a value attached to this immovable property. So they're talking about this immovable property. Because here it says there's no value, but now it says there will be a value, however, if the remuneration proxy exceeds 250,000, or if the market value exceeds 450,000 for the property, or if the employee is a connected person to the employer, such as a shareholder. Now, so see what this means. How can we restate this? There is no value on the immovable property if you earn less than 250,000 rands and the property is worth less than 450,000 and the employee is not connected. So I'm going to make that comment here. Okay, so there's no value on the immovable property if the remuneration proxy is 250,000 or less, the property market value is 450,000 or less, and if there's not a connected person. That's the other way of looking at it. Right, I'm saying here the remuneration proxy is often given. I just need to restate that. I will also make that note in your slides. And just to say it, the remuneration proxy will be given. That's what the examiner pronouncements say. Sorry, this block, just need to change it there. All right, guys. So, paragraph 5.2. So this is now where we look at the cash equivalent. So this is the amount that the employee is going to include in their gross income, or if they receive an asset. So there's three categories. The first one is an asset was purchased to give to the employee. Now, let me explain. This is where the employer goes out specifically and buys something to give to the employee. So for example, let's say you've worked for the employer for 3 years. After working for 3 years, the employer says, now we will give you a television, a TV to take home. So the employer goes to the shop, buys a TV and gives it to you. That's what they're talking about there. It's specifically given So if you weren't there, they wouldn't have purchased it. That's the way of thinking about it. In that case, whatever the cost was to the employer, that is the amount that you will include. Okay? Then, if the asset was used by the employer first. So this is, for example, the employer went and bought something to use in the business, and now they give it to you. So, for example, they have an old computer, 3 years old, and they say, here's the computer, you can take it home. So they bought it not for you, but now they're giving it to you. Then you use the market value. So whatever the market value is now. So it might have cost 10,000 rands 5 years ago, it's now worth 2,000 rands. You only get taxed on what it's worth now. This also applies to shares. So this means even if the employer goes and buys shares specifically to give to you, you'll use the market value. Okay, so just be aware of that, shares. And then trading stock. If the employer gives you some of its trading stock, you use the lower of the cost or the market value. Now, whatever value you calculate here, you can reduce that by 5,000 rands. That says here by the lesser of cost of 5,000. Let me explain to you what that means. Let's say the asset, the value that you calculate here is 6,000. Then you can reduce it by 5,000. So it becomes 1,000. If the value is 4,000, you can only reduce it by 4,000. That's why I'd say the lesser of cost. So you can only go to 0. Okay. When can you do this reduction by 5,000? If the employer gave you this asset for bravery or for a long service award. Now, bravery is not defined in the Act. So it's something that the employer will have to decide what bravery is. Now, obviously, guys, you can't be giving this if you are a cashier at Pick and Pay or Checkers, and every day you just arrive at work and they give you a bravery award, or if you are doing your articles and you're so brave for just trying to survive every single day and going to work every day, that's not a bravery award. A bravery award will obviously be for a police officer, or a soldier, or security guard, someone like that does something that's brave, rescues something or stops someone. Okay, not just you filling in a spreadsheet very well. What is a long service award? That we have a definition for. A long service award is if you have worked for the employer for an initial period of at least 15 years. So the first time that you can get a long service award is after you've worked for 15 years continuously. Then after that, you can get it for every period of subsequent unbroken period of not less than 10 years. So you start working here. After 15 years, you can get the first 5,000. Then after 25 years, then after 35 years, every time you can get it. Okay. Now, just make sure that you read carefully here. You qualify for the first time after 15 years. So let's say you qualify for the first time after 15 years, but your employer's own, because remember, this is a tax rule. That doesn't mean that you say it's your employer. Your employer can give to you after working there for 5 years, or after working there for 10 years. Okay, that just means for tax it's not treated as a long service award. So let's say your employer decides to only give it to you after 20 years. Then the next time that you qualify is 30 years. So 10 years from whenever you qualify the first time. So you can't accumulate it and go 15 years, 25 years, 35 years, and then retire and get 5 times 3. Right. Now, this 5,000 rands also, guys, has been 5,000 rands since I studied. So, yeah, you don't really get a lot of discount from tax for long service award. Oh, and also just, guys, one quick reminder. When we are doing the VAT here, the output tax, the cash equivalent is what you will use times 15 over 115. And this cash equivalent is usually excluding VAT. What do I mean by that? Just as a reminder, X limited buys trading stock for 115,000 including VAT gives it to employee as a fringe benefit, and market value and cost are the same in this case. Okay, so when you buy it, you debit trading stock, you debit input tax, credit bank. Okay, now when you give it to the employee, so first thing I want you to understand is that this is the cash equivalent. Because when you now give it to the employee, you say credit trading stock, okay, because we're looking at it from the employer side now, just as a reminder quickly. You credit output tax, and you debit salaries. Now, this is your cash equivalent. How do we calculate the VAT? Cash equivalent times 15 over 115. So 100 times 15 over 115. 13,043. So 13,043. So that means your salaries is 13,043. This is the amount. Sorry, 113,000. This is the amount that you can claim as a deduction as the employer under Section 11A. And if we are looking at this from the employee's perspective, right, they'll have an asset acquired at less than value. And it's trading stocks at lower cost of market value, and just assume for now they're the same. But I'm trying to explain to you the amount that they will include is the amount excluding VAT. So this is where, just as a reminder, you covered this on the VAT, but this is where students mess up because they go, but this is an amount excluding VAT. Yes, that's correct. You still have to apply the tax fraction to that.